welcome to the Global View, a budget special with me, Tanvir, Gill. Over the course of the next 30 minutes, we get you a quick slice of what foreign investors are expecting from the budget, from the big event. Joining us from across the world with their expectations are Arnab Das from Invesco. He joins us all the way from London. Adrian Mowat, somebody who tracks the Indian market very closely, joins us from Hong Kong. Sean Taylor of Deutsche Asset Management. He's the head of emerging market equities. We'll also talk about what will it take for him to increase allocations to India. What in the budget would he be watching out for? And then Lawrence Bilanco from CLSA, somebody who looks at technicals very closely, will highlight to us how the markets are preparing for the big event. Thank you all very much for taking out the time to speak with me today. Arnab, I'll start off with you. What are your top three expectations from the budget?
Well, I think the focus in the markets and in general among the community is going to be about the headline number of the budget deficit. And in addition, whatever structural measures there might be, particularly with regards to the banking sector and signals about reform. So, I mean, I think, the RBI governor has basically thrown the ball in the government's court with respect to the structure and the balance of the budget as a signal that probably further easing depends on how much the budget will contribute to improving the potential growth outlook of the economy, keeping inflation under control, and so on, right? Because after all, we have a bit of stickiness now in inflation. We have a bit of food inflation coming through again in India, and probably a signal that the easing process on its own merits is coming to an end.
Adrian, same question to you. Your top three high recall points that you'll be watching out for in the budget.
Look, the next week is a very important inflection point for India. If we have a disappointing budget and the Reserve Bank doesn't start to cut policy rates more, then I think that'll be a negative message for investors. Now, as we go into this budget, expectations are quite low. Investors are nervous moving in. They've been selling the market down. So it is possible that this budget could surprise positively. Then if we got follow through from the RBI, maybe cutting policy rates by 50 basis points, then I think Indian equities would recover probably quite sharply if you hit those two conditions. So we're looking at a reasonably important event risk with the budget and with the RBI policy. So this is unusual because the budget has become less and less relevant for markets. I think maybe the budget is more important this time.
Sean, when I spoke to you a couple of weeks back, you were circumspect about the fall in India and in emerging market equities, actually across the world. What are your top three wishes from the upcoming budget?
Some more focus on the rural area and some of the reforms. Maybe a decrease in the corporate tax rate, which is too low relative to what the GST target is. And maybe a touch up on the service tax, which is a bit low.
Right. Lawrence, how are you looking at the technical charts for the market right now, the Nifty? Because it's been a weak start since the year, and we've broken key technical levels. So stepping into the event, how do you see the trend to pan out on the index?
India peaked mid last year, and we've seen a clear downtrend develop in the Nifty. We've got down to the 6,900, 7,000 area where we've seen some support come through, but we're still in a clear downtrend. And in the short term, I think we can move back towards the 50-day moving average. But if you're looking at it on a longer-term perspective, we're still in this downtrend channel that we developed off the April 2015 highs. I think if you look at the longer-term charts, if you go to the weekly and monthly time frame, you can still see a clear uptrend. And the important breakout happened when we cleared the 2008 and 2013 highs, and that sits back at the 6,300 area. So as long as that support area is intact, I think the broader bull market structure for the Indian market is still intact.
Right, Arnab, the key concern is fiscal management. That's going to be top of the mind. If the government chooses to ease a bit on fiscal consolidation to increase spending and investment, thereby to push growth, how would FIIs or foreign investors, economy watchers such as yourself, take to that decision?
I think if it's a small adjustment in fiscal policy, small expansionary thrust, that won't be too bad. I think that the challenge here is that the Modi government had created, both during the campaign and subsequently in the initial legislative phases, and then after the setbacks in the various state elections, had created expectations that the reform process would have its own momentum, right? Whether through legislation because of a single party majority in the lower house or because of executive actions and so on, that there would be a good deal of momentum. And I think that momentum has largely dissipated. Of course, there have been various setbacks and some progress here and there. But what I think kept interest very strong and very much alive in India was the Rajan RBI managed the situation after the taper tantrum very well. Did a very good thing in shifting the framework of the RBI towards so-called flexible inflation targeting. And then the country as a whole, and particularly the disinflation process and the task of the RBI, was made a lot easier by the collapse of commodity prices and oil prices in particular. Now that is all good news as a combination of luck and policy, so somewhat by design and somewhat fortuitous. That can only take you so far. And I think in order to validate the hopes that India, which now by the official numbers is the fastest growing large economy in the world, outpacing even China, to keep that story going and to attract more foreign capital, more domestic capital, more investment, various structural things have to be done, no matter how politically difficult they are. And I think that's really where we are, that there's a kind of sense of fatigue showing up in the markets because things are reasonably good. They're not great. They're not terrible. There are concerns.
Same question for you, Adrian. How do you think foreign investors sitting out of Hong Kong, Singapore, London, New York would look at the government's fiscal consolidation path and, the flexibility they want to kind of build into it to increase spending, to increase investments, thereby, keep growth firmly above the 7% mark? Would that be something that FIIs will take in their stride?
I think the most important thing is a fiscal help to the economy. So we'd be looking for an increased budget on capital spending and perhaps also a little bit of help to rural India that's had to deal with a monsoon and is not getting the same increase in minimum support prices. Now, I think with regards to taxation, there are clear concerns out there. The Vodafone case seems to be back in the news headlines. There are some talks about increase or reimposition of long-term capital gains tax. It just reminds everyone that India's tax structure for investors, particularly cross-border institutional investors, is a competitive disadvantage for India, not a particularly good idea in what appears to be a global bear market. So yes, we're interested in tax transparency. We certainly don't want to see an increase or a reimposition of long-term capital gains tax unless it's properly done with an exemption for both domestic as well as international institutions. But above all, what I want to see is some help to this economy in an increase in capital spending.
Adrian, okay, so given what the government does on fiscal consolidation, what is your expectation in terms of growth targets? What kind of growth number or projection would appease investors such as yourself? I mean, we're talking about broadly a range of between 7.5% over the course of the next 2 years.
Do you know, I think that the problem with that question is that if the government comes out with a high growth target, people may treat that with suspicion because they fear that the fiscal target in terms of the deficit relative to GDP is being achieved through too high a forecasting growth rates. Now, there's an important issue with Indian growth that's also a global issue. India's deflator, so the inflation component of nominal GDP, has come down by nearly 3% relative to the median deflator in the last 5 years. And so I'm more interested in a sort of combined nominal GDP forecast. But if it comes out that the government's forecasting one that's too high, then that's a negative. So, interesting question, but not one that investors have been asking me about. I would actually make an observation around the budget. I've been marketing, seeing clients for the last couple of weeks. no one is asking me about the Indian budget. It seems to be more of an issue within India. The global issues people are focused on are China's currency. What does negative interest rates mean in Japan? Why have bank shares being sold off so viciously in Europe and the United States, rather than sort of focus on this Indian event, which is clearly important for the Indian market, but it's not front and center with the investors at the moment.
Sean, what about earnings growth? Because corporate earnings have lagged despite the headline number ranging between 7-7.5%. How do you see the trend line on earnings growth over FY16, which we are closing out, and then more importantly over FY17?
Yeah, I mean, what we're missing, Tanvir, is the credit cycle. We're not, the market's earnings expectations are still too high. They're probably going to come in around 10 to 12% in our opinion. The market consensus has a higher than that. Earnings are disappointing from financials to consumers to industrials. They're still, in perspective though, they're still pretty good relative to the rest of emerging markets where we've got negative earnings growth for the rest of emerging markets. But there's no real immediate catalyst for investors to get excited about the Indian equity market on an earnings basis. At the moment, we still have to wait another couple of quarters.
Arnab, central to the budget fiscal math is also going to be the 7th Central Pay Commission rollout. How will that impact long-term growth projection? What do you expect the government to say or do to manage the quality versus quantity debate on maintaining that fiscal balance?
In various countries in emerging markets, including in India, this issue of increasing wages, increasing public sector wages in particular, that's going to be a matter of some focus. And I think one of the things that may happen as a consequence of this budget is that in the case of India, the focus may widen from the federal budget balance, and whatever consolidation measures can be offset can be used to offset whatever comes from the Central Pay Commission at the federal level. Focus may well widen to take in the state and local governments, which if you look at the general government balance in India, it's not nearly as healthy as ideally it should be, right? It's in mid sixes and may try to go up, may tend to go up a little bit from there. It won't be a very serious problem in all probability to finance, because nominal GDP growth is still north of that level. But there's concern that too much is being done on the demand management side through the RBI and through the budget balance, and not enough on the supply side through structural measures and reforms.
Adrian, I know you mentioned this before as well, but top of the mind for foreign investors would be GST. I mean, I've spoken to investors who are saying that they would increase allocations to India if GST becomes a reality. How high are the hopes of GST clearance pretty much paving the way for renewed investor interest in India?
Yeah, so most investors have put any chance of legislation into the very low probability box. So I think it would be a positive surprise if GST was passed in India. I think there's very low expectations of that, and then almost zero expectations of the land acquisition being passed.
Adrian, another top of the mind concern for investors, especially over the last few days, has been the government revisiting long-term capital gains tax. How are you reading into the concern? I mean, there are murmurs and rumors in the market. How are you reading into the concern right now? And what do you think would be the impact of it on the markets and even in terms of flows?
It would be a very negative reaction. I think that's the answer. I go back to this point. There is an ongoing confusion in the way that you tax individuals as opposed to institutions. If you tax institutions that are providing investment services to individuals, the individual ends up paying tax twice. So international investors going cross-border are not subject to taxation in any other emerging market that I look at. I'm talking here about capital gains tax. You will see some withholding tax. So this imposition of a long-term capital gains tax in India would just remind us of India's competitive disadvantage in taxation of international equity investors.
Sean, since you manage allocations to India and you're looking at this budget closely as well, same question to you. How are you reacting to these rumors and murmurs about the government looking at the long-term capital gains tax? What are the chances you think the government would kind of tinker with it? And how do you measure the impact?
Look, if it comes out short term or the rumours start to get louder on it, yes, it would make the market fall short term. I mean, if you compare it to other markets, then India would be less attractive in the long term. But you have to offset that about growth. You can't say, well, what we would do on one particular point of news. It's all very relative. And at the moment, the Indian story is very much predicated, as you know, on reasonable growth that hopefully will come through in time, comes into earnings, and that makes the sort of infrastructure and the private financial sector and some of the better run consumers very interesting. If we start to get the long-term capital gains tax, then you're comparing it against other markets that don't have it. Well, then obviously it is going to penalise the sort of investment prospects of India for foreign investors. Yeah.
Arnab, what would the fiscal flexibility that we just discussed earlier on in the show mean for monetary policy action? I mean, do you think that would lead to pause in rate cuts? Because, the RBI has given about 125 basis points of rate cuts over the last 18 months to the markets, to the economy. So now, with fiscal measures kicking in, the RBI may want to be in a bit of a wait and watch mode?
Yes, I mean, I think in a way, Rajan putting the ball in the court of the finance minister, that is a signal that if you do too much pump priming on the fiscal side, we will be in a position where we have to do less or nothing, perhaps, on the monetary side, depending on how the economy plays out. And I think the growth process, so far as it goes, is robust enough. What needs to happen, like I say, is more structural stuff rather than fiscal pump priming or at the stage even monetary policy, right? The NPLs have to be dealt with in the banking sector if credit is going to pick up and generate an investment push to the economy. And in addition, to validate that improvement in bank balance sheets that still needs to happen, various things have to be done to make the business operating environment in India that much better, right? All those bread and butter kinds of things like land reform, labor reform, GST, which are all sort of stuck in the water at the moment.
Arnab, how are you looking at the NPA mess in India, which is only getting worse with every passing quarter, and the approach that the government and the RBI have taken to the problem, especially in terms of higher accountability and higher provisioning? PSUs, of course, are bleeding on that front, but even some of the private banks have shown up signs of bother within that space in the quarter gone by.
Right. Well, I think that's created a little bit of a concern in the market, but I think beside the kind of effect on people's positions and concerns and let's call it sentiment, fundamentally, I think it is a very good thing for the institutional setup in India, for the framework of governance, that the central bank is pursuing this route, right? It shows you that there is a strength in the institution, which hopefully will continue, which will outlast Rajan himself and the other members of the executive level of the RBI, and be a bulwark against doing the wrong thing and a pressure for doing the right thing at the political level. So short term, it's a challenge, and I think sort of saying there's been enough forbearance, right? That we need to deal with this problem. We need to grasp the nettle and move on, is exactly the right message, right? I would say it is the message of the global financial crisis, the crisis in the Eurozone, and many crises in emerging markets, many banking crises. India is quite far from a banking crisis. I'm not trying to suggest that that's the case. But it is the lesson of many experiences in many countries that if you don't recognize bank losses that have in effect already occurred, then you're imposing a deadweight loss on the banking system that is, although unrecognized through forbearance or just by plain looking the other way, it means that the banking system is weaker than otherwise and weaker than it should be. And that almost always means that credit growth, take a direct approach and stimulate credit, as happens in some countries. Unless you take a direct approach, credit growth will be weak, investment growth will be weak.
Sean, what about you? How are you looking at the entire banking space in India and managing your investments there? Are you keeping your conviction with the private banks that you spoke about a few weeks back?
We've been fairly selective. We think we're in the higher quality ones that don't have as many issues. Obviously, I'm restricted from talking about individual names here, but clearly a number of the banks have a worsening, deteriorating NPA problem, and at the same time the growth's not coming through. So it can't be. It's a more difficult environment, which is why some of the top-rated banks are getting a higher and higher rating every day, relative to the sort of state banks that are getting a lower and lower rating every day. Sometime that has to change, but I don't think it will change in the foreseeable future. But I think you have to put it in perspective against other markets as well. It's still pretty controllable. It just dents the valuations.
Also, Sean, what could the budget mean for the Indian market, which is currently trading at 14 times FY17 earnings, trending closer to the historical buy range? Limited downside would make it compelling to invest in the Indian market right now?
I think the market's. I think the market, given current situation, Tanvir, is troughed. I don't see an immediate catalyst for people to get more excited, and I still think some of the technicals are still against the market. FIIs are generally still taking money out of emerging markets. That might stop now, depending on what's happening with the US rate cycle, and stabilize, as the sort of issues in markets seem to be more in the developed world as opposed to the emerging world. And I think the second, really powerful driver of Indian equities over the last 18 months has been domestic investors, and they seem not to be buying as many equities as they were before. But that probably will stabilize again, and it was probably because of the volatility in global markets. So yeah, it's still a patience game. We would be looking to opportunities to add over the next couple of quarters.
Sean, same question to you. Two high conviction buys sector-wise in lieu of what may happen in the budget.
Yeah, I mean, obviously infrastructure and the change from the rural economy going into the urban economy, and any evidence there or any sort of potential reforms rather than just subsidies there. That's obviously a medium-term catalyst. I'm not sure it's going to be too aggressive in the budget coming up. And this obviously, as I talked about, was getting the credit cycle going and what's going to be happening to the banks and recapitalization, or what the long-term story is there, is obviously a key, and that's probably one of the most disappointing parts of the Modi government, that we were expecting more reform in the financial sector, and to us from the stock market, that's the real key, I think, because as I said before, if you're building. If you're laying down the foundations of a very, very positive investment cycle, you need the banks. The banks are, they are the lifeline of the economy, and you need them to have money to lend to people that then gets the economy going and the multiplier effect. So yeah, it's very, very key.
Also, Lawrence, before we let you go, for the benefit of our viewers, highlight your top 3 stock strategies in the Indian market.
Well, I mean, globally, or India in particular, you've had the banks lead the decline. So the banking sector was the first sector to peak out and break down. And I think going forward, it would be the sector that I'd be watching closely to show the first signs of the Indian market stabilizing. Now, we're not seeing that yet. Momentum indicators have been confirming the recent lows in the broader CNX Banks Index. So that downtrend that we've seen in banks is still intact. I mean, the two sectors that stand out to me here as becoming quite vulnerable is the technology and the pharmaceutical side. They've acted really well over the past 2 years at least. But looking at the breakdown that we've seen in technology stocks globally now and the pharmaceutical stocks, I'd be quite concerned that the CNX pharmaceutical sector and the CNX RT sector follow to the downside. And to me, that's the space that I'd be most concerned about, and how the Nifty can trade down towards a 6,300 area. It won't be driven any further by the banks, but it will more than likely be the technology and pharmaceutical sectors.
Gentlemen, thanks very much for joining us today and giving us your perspective and your expectations from the upcoming budget. The countdown has begun, so let's see what the budget has in store. For now, thanks very much for watching this special edition of The Global View.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.